Hello, hello.
Hey, welcome everyone. Wow, lots of people. Good thing you guys are reading my emails. I'll make you a host too, just in case. Wait, let me see here. Feel free to say hello, guys. Don't be shy.
All right then. Hello.
Hey, Troy. How are you, buddy?
We're doing good. And yourself?
Yeah, one day at a time.
One day at a time, eh?
One day at a time.
Yeah, that's all I live by. I just get up, do what I feel.
I wish I could live your life, buddy. You're my hero. Co-host. All right, Danny's a co-host now. Okay, let's give everybody a couple minutes here. I think some people are kind of working and hiding their iPhone and listening while they work. I see Dimitri kicking the kids out of the room. Good job.
Yeah, we're running in the room there.
Okay, still lots of people. Dan, people want financing, buddy.
I know. Look at that. I don't know if it's me drawing the crowd or whether it's you, Paul. I mean, I like to think it's me, but I think it's more you.
Hey, Daria. Sue, how are you? Yeah, Moj says Daniel has already got 7 or 8 mortgages for us.
There you go. Moj. I see a couple good clients. I see Kyle on there too. What's up, Kyle? It's awesome. Moj is a very loyal supporter of mine too. So hi, Moj. Is Moj on camera?
She might be hiding at work.
I might be hiding. 60 people. Wow, look at this. Paul's a celebrity.
So were you up the cottage or something?
No, this is my house. I just have some big trees in the backyard.
Good for you.
I talk loud, so my girlfriend gives me like 200 square foot sunroom to just sit in all day and locks me in here so I'm not yelling while she's working. Do what the boss says, makes my life easier.
Hello, everyone. So everyone, I see a bunch of questions about recordings. Wow, so many people. Yes, this is recording as we speak. So I've now set the Zoom to automatically record as soon as I start a meeting. So because I forget things. So as soon as I have it, I'll get it and I'll fire it off to everybody. If you don't get it in your email or something, just shoot me an email. I'll send it to you. It's not a big deal.
Hi, Obina. It's great. I love seeing familiar names in here.
Yeah, I forget how many people we know.
I know. I feel like whenever I talk mortgages on these, I feel like my clients they get bored because I feel like it's stuff they've already heard me say. They're like, "What am I listening to him for? I've already heard him say all this."
Well, I'm gonna hit you up.
No way. I like to hear you talk mortgages all the time, Dave. Daniel.
Well, I appreciate that. I try to have some passion when I'm talking finance for investment. We love passion. Investors love that. It's what gets us up every day. It's that entrepreneurial blood.
We're going to hit you up today because we got big questions and we want to know.
Good. I love it. I hope I can answer it.
Okay, so I think we should start talking a little bit here. So I brought Daniel on today just to talk about kind of what's going on with financing, and Moj's comment was perfect segue. And my goal is to always connect you with somebody, especially if you're in my network and you're wanting to buy properties and be a big investor. Well, you can't be a big investor if you don't get financing. And if you have all the cash in the world to buy all the properties you want, then you don't need to buy properties. So the point is you're going to need financing one way or the other. And like Moj has 7 or 8 mortgages, using one broker, I want you to be able to get the same thing. And not everybody can do that. You need to have, special skills. And to preface that, I'm going to tell you guys a little secret. Nobody calls me because I'm a realtor. There's 103,000 realtors in Ontario. Nobody, and I mean nobody, calls me because I'm a realtor. And if they do call me, I hang up the phone. I'm like, you don't need a realtor if you're calling me. So people come to me because I'm a specialist in working with investors, and I know how to create strategy and help you build a portfolio that really has a positive impact on your life, right? Who cares how many properties you have? Doesn't matter if you have 5 or 10. This is not a popularity contest. But really, the whole point is that your portfolio has a positive impact. So you can have a nice view like Dan has. So you have that big red Ferrari that Dimitri wants, or like Dimitri, you can just sell your business and invest in real estate full time like a boss, right? Or you can retire like Troy there and sit on your massive property and be a boss there and plant trees. I love this stuff. You know what I mean? So it's all about that positive personal result. And we use real estate to get there. And we've done it a million times and we keep doing it. But you need financing. So that's why Dan's here. Okay. So get your questions out if you need them. And I'm going to start bothering him soon with some stuff. But maybe, Dan, you can tell us who you are and what you do for people who don't know you.
Well, I really appreciate the intro. So I am a mortgage specialist, and as Paul mentioned, I would echo that. We specialize more so obviously in the investor world. That's how we've built our business. We've been working with Paul for many years, Paul's team. We work with the Rockstar Network. We work with many investors. This is really our thing. And as Paul mentioned, it's key. The banks have great product. We love the banks. We use the banks, but the banks can be limiting in terms of options. Obviously, if we're going to BMO for, directly for our answers, we're only going to get BMO results. That's it. And it's important to note for investors, especially if you want to scale a portfolio, every bank is different on how many properties they're going to allow you to own, how many properties they're going to, allow you to qualify for, how many you can hold, whether they do student rentals. I mean, it's very different at every lender. So it's key to have somebody like myself or a finance specialist that knows the ins and outs of all the banks. And what a little known secret about mortgage brokers is even mortgage brokers like myself, we actually only have the ability to work with 2 banks directly, Scotia and TD. So even if you're going to a mortgage broker, you have to make sure that mortgage broker works with investors, because investors need access to RBC, to CIBC, to BMO. They have great product. So it's very important for us to work with people who know what they're doing. I always say the coach, the real estate agent's the most important. And Paul is kind enough to say the financing is equally, but surround yourself with good people. A coach, 100%, finance, legal, accounting. These are all things that as investors you're going to need as you scale. So I'm happy to be here. A little bit about us. I've been doing mortgages for about 18 years now. My business partner and I, Dave Butler, have been working with investors in particular for about 16 years. We are the #1 mortgage team in Canada. We did over $550 million in funded deals last year. We operate mostly in Southern Ontario. So for anybody that's joining outside of that region, that's typically where we operate. But COVID has brought new opportunities, and we see more opportunities now in Calgary and Quebec. Like we're able to do deals all across the province. I think the digital world has brought forth more options, but primarily Southern Ontario. We love Southern Ontario. And again, I've known Paul for Paul, like 12 years, 10 years, something like that. How long have we known each other for?
Something like that.
Yeah, long time. Who's counting when you're too busy doing real estate, right?
Yeah.
So no, I appreciate it. It's a pleasure to be here. Happy to answer any questions. I'm sure, there's questions on rates, there's questions on policy, questions on lenders. So I don't know, Paul, if you want to open up the floor or if you want me to.
Well, I'm going to dig in a little bit here because there's some important, wow, we got over 80 people here. I'm going to dig into an important one here because it's coming up more and more often, and I need people to understand, and I need them to hear it from you, so I don't sound like a cheap salesman. Like sometimes I wear my salesman hat, I know, and I have to drag you guys by the neck sometimes, but it's important that we understand the changing landscape of financing. And I want Dan to talk about B lending, why it's become more popular, why it's not as bad as people think, and how investors are using it successfully.
Excellent question. Very good. So B lending, you're 100% right. B lending has pushed itself into, into the realm of we want A clients. You know, B lending before used to primarily be, you know, oh, well, you have bad credit or you have no income. This is where you have to go, and they're more expensive. And traditionally, that's how B lenders work. They're a little bit more forgiving when it comes to credit. They're more forgiving when it comes to self-employed people. Obviously, you know, in Southern Ontario, there's a lot of small business. There's a lot of self-employed. So where B lenders recently, over the last few years, have really made a push for clients is in this self-employed world. You know, banks traditionally, if you're going to a big bank to try to qualify for a mortgage, they're looking at three main criteria, right? They're looking at A, do you have good credit? Because if you're going to a big bank, you have to have good credit. That's non-negotiable. So yes, I have good credit. B, they're looking at, do you have the minimum down payment and is it acceptable to us where it's coming from? So when you're buying investment properties, you have to have 20% down and it has to come from an acceptable source to the bank. It can't be cash in a shoebox under your bed. The bank doesn't accept that as down payment. So down payment is very important. And then the last and equally as important is your debt ratio. And that's where the bank is looking at your employment and your liabilities. So the bank is always looking at your provable income, which we know for the self-employed is usually lower than what we're making. We have our advantages of write-off, so we're not claiming as high of income. Well, this will cause a problem in your debt ratio with the banks. You know, 20, 30 grand of provable income isn't going to qualify you for much. So the traditional thought for those self-employed people would be, well, why don't I just claim a higher income? And that way I can now qualify to go with the A banks, because I don't want to go to the B lenders, because the B lenders are only working with bad credit. And that's not me. I just want to go to the A bank. Well, nowadays, in terms of qualifying, depending on your existing liabilities, you could be looking at having to show like $100,000 in provable income to qualify with the A lender. So the question oftentimes for the self-employed person isn't about what's the lowest interest rate you can get. It's what's saving you the most money. And that's a question that we usually equate to having the lowest rate. But for the self-employed guy, that's not necessarily true, because a B lender is not looking at your taxable income, that line 150 that as the self-employed, we generally keep low. They're going to look at like a 6-month history of your business activities. So your business bank statements, you know, even your personal bank statements, if that's where your money is going. But the B lender is way more forgiving. Now, the B lender only operates at 20% down. So you have to have a minimum of 20% down. But the income that they show is pushing, or that you need to show is pushing more self-employed people. And when you look at the comparison of rates right now, I mean, B lenders used to be 5%, 6% back when the A lenders were 3%, 4%. But now that the A lenders are down, you know, closer to 2% on average, you can get B lending on owner occupied homes at like 2.5% to 3%. And you can get, you know, on rentals, you can get 3 to 3.5%, depending on location. Now, a B lender is going to be more expensive in two ways. One, they're going to charge a higher interest rate. So if you say an A lender is going to be 2% and a B lender is going to be, let's just say 3.5%. Well, maybe on a $300,000, $400,000 mortgage, that's going to be a couple $100 a month difference. Okay. So they're going to be more expensive right there alone on a monthly payment. So if we say, okay, $200 a month, that's $2,400 a year in extra payments that we have to carry. Okay. A B lender as well will charge a 1% lender fee on closing. The lender fee is 1% of the mortgage amount, not the purchase price. So if we're borrowing $300K, $400K, we got to pay them $3 to $4K on closing, 1%. Now, this isn't a fee we have to pay every year. As a fact, even if we took a 1-year term with the B lender and renewed with them, we don't have to pay that fee again. Okay, we pay a small renewal, but that 1% fee is a one-time fee on new money that you borrow from the B lender. So the question in most cases, Paul, sorry to give you a long-winded answer, but for the self-employed person, the question again is, what's the cheaper route? Having less income to file and pay taxes on and accrue a cost of a higher interest rate, which might be $2,400 a year, plus a lender fee of $3,000, let's just say, or $4,000, that brings you up to like $6,000, $7,000 in terms of extra payment. So what's the cheaper cost? Going to an A lender, claiming $100,000 in income and paying the tax on that, or keeping the income low, going to a B lender and paying the difference in interest rate and then the lender fee? And I think what most self-employed clients are finding now is the B lender is the cheaper route for sure. So that alone has pushed B deals way more forward than they ever have been. I'm sure you remember B deals before. That was your bad credit, no income. Now, self-employed people find it as a huge benefit and affordable, because 3.5%. I mean, remember, interest rates at the big banks 2 years ago were 3.5 to 4%. So the B lender rates are really affordable. Sure, it's, if you look at them side by side with the bank, they're more expensive, but rate isn't always the driving force for investor. It can't be. Otherwise, there's a saying, you can't bend over dollars to pick up dimes. So you can't focus too much on that. You got to look at affordability.
So let me summarize that for some people who didn't catch the main point there. And I knew you were going with this, so I want to summarize it real quick. So if you're self-employed and you're making 150, 200 grand on paper, and you smash down your net income to 50 grand on paper with all your expenses, so you pay less taxes, right? That saves you, I don't know, $20,000 in taxes payable to the government. And then now you can't qualify for a mortgage with TD or Scotia or RBC or CIBC because your net income on your T4 is low. Well, we go to B lending, and you pay an extra $200-300 a month and a fee, even if it costs you an extra $10,000 in the first year to service that mortgage. What's cheaper, an extra $10,000 in interest? That's a write-off completely, or paying $20,000 to the government that you're never going to get back.
Not just for 1 year, but remember, when the banks want a 2-year history of that income. So when you have to claim 100 grand in income, it's 2 years of taxes minimum.
Right. So you have to do the calculation. What's worth it for me? Claiming a higher income and clearly paying a lot more taxes, or paying a slightly higher interest rate and a one-time lender fee that you can write off on your taxes completely. So that's the message I'm trying to bring across to people. But again, I sounds like I'm wearing my salesman hat. So now you hear it from the horse's mouth. So it's a real option. So if you hear me say B lending, don't think he's crazy and he's trying to jam a property down my throat. It's a real strategy. And to be fair, the last mortgage I got, me and Andrew bought a triplex, was B lending. It wasn't a commercial deal, so we couldn't go commercial, and we didn't have time to mess around with credit unions, and these guys take forever. So we had to take B lending, and our rate was like 3.69%. I don't care. I paid 80,000 under market value. I'm going to piss away 80 grand in profits on day one because I'm paying a couple $100 more in interest. Doesn't make any sense. And the way I see it, if after I'll take my chances with B lending on a 2-year term, and then try and refinance or renew it into A lending after I have some payment history or whatever. I know that's never a guarantee, right, Dan? But at least
no, and that's a really good point, though, because working with someone like myself or my team, that's the plan. We would want to tell you, this is the income you would need to show, because some people are close, right? If you're sitting there claiming 70 grand, 80 grand a year, and I need your income at 90 grand, well, maybe you want to bump it up, but you got to have that convo, and you have to have a plan in place with your finance so that you know exactly what to expect. Real estate and investing is a lot about anticipation. So you can mitigate a lot of that risk by just knowing, okay, if I claim X amount of dollars, I can move it to an A lender. What are my costs for that? Doesn't make sense to do it, but definitely, yeah. Shorter term with the B lender, you never really want to go more than 2 or 3 years, even like 3 years a little long, but 1 to 2 years is pretty standard, because the idea, like you said, Paul, is yes, we want to try to leave the B lender and move it to an A lender at some point.
Yeah, you're not going to be in there forever. Okay, so I have a question. This is a good one. This is the kind of feedback I get when I'm sitting in front of someone. Why do B lenders treat you like garbage by taking money for property tax, assigning rent money to the lender if you default, and after 1 year, most of the payments go to interest and mortgage principal barely budges? Thanks.
Well, okay, so I'm the B lender's not treating the client like like bad because you're not dealing direct with the B lender in most cases. You're dealing with the broker. So if you're having a bad experience, it's probably the contact, not necessarily the bank. But the truth is the B lender they don't work in the same world as the bank. And a lot of times people think that, oh, well, they're charging a higher rate, or they demand that that they pay my property tax. Well, the B lender is about risk assessment. And the one thing that we have to understand, and it's funny about with property tax especially, is most people don't know this. if you default on your mortgage, let's say you go in arrears on your mortgage and you have to sell your house under power of sale, guess who's the first person to get paid? Okay, it's not the bank, it's the property tax. That's who gets paid first. So the B lender is more so invested on the property. That's why you get access to them. They're not so worried about the applicant, your provable income, and we're not so worried about it. Okay. Our concern is, look, if you don't make the payments and we have to resell this house, are we going to get our money back? That's what the B lender's focus is. It's risk. So when they're insisting on collecting your taxes, they're saying that because generally, if somebody goes behind on their mortgage, they're already behind on their property tax. That's the way it goes. And if a market is declining, let's just say we had a change in the market and the value started to drop, the B lender is worried that if you're behind on your property tax and the market starts to drop, they're not going to get their money back because the property tax goes first. So the B lender will put a priority on, no. We want to be in control of the property taxes because we have to make sure that's paid so we can keep our eye on the fact that we're going to get our money back if something changes in the market. Now, it's funny. The A lender also collects your property tax assessment, but they do it more and say, well, it's a convenience for you. Why pay it yourself, every few months or annually, and we'll just take it out for you. So perception sometimes is reality. And some people see that as, well, I don't want them having that much control. And other people say, yeah, what do I care? It's easier for me.
Yeah, for me is they just saved me a small little bit of time on the bookkeeping. I don't care. Pay my
Yeah, me too. It's easier for me for them to take it, but some people prefer to do it on their own. But that's why a B lender is so insistent on it. And an A lender will give you a little bit more flexibility.
I can't see your full name there, D, but the reality is these guys have to protect their bottom line. They're not dealing with a bank worth $10 trillion. And these guys might not have an HR department either. They don't care. It's like, they have to protect their risk. And if you want their money, this is the terms. But
well, and
luckily you only have to do it for a couple of years or maybe 1 year and you get out of there and go wherever you got to go.
They serve a purpose. That's the thing. One thing this is sometimes shocking for people to hear, but it's the truth. The banks don't have a large appetite for rentals. They'll tell you that. They'll do rental deals if they like the investor, if they like the property. They'll do them all day long, but they'll outright tell you we don't have a massive appetite for rental properties. That's banks and B lenders. Why? Because a bank is designed to draw you in with a mortgage. Okay, they're not making most of their profit on a mortgage alone. They're drawing you in to try to cross sell you. They want your first time buyer. Hey, we'll give you a great rate and we'll give you a checking account. We'll invest for you. We'll build a relationship and we'll sell you a bunch of ancillary products. We'll get you credit cards. We'll get you lines of credit. That's the investment that a bank is doing. Well, investors aren't really looking for that. Investors are looking to park their mortgage at a bank at a low interest rate. They don't want any of that other product. So the banks recognize the amount of labor and work that has to go into just getting one mortgage approved. So if they like the deal, if they love the investor, they'll do the deal. And that's how B lenders sometimes work as well. It's like, look, this is our setup. If you're self-employed, these are our rates. They're higher. You don't have to prove income. You don't have to do this. And maybe sometimes that comes across as, difficult to work with, but they just have their rules. That's it. And if we don't fit in their box, much like we don't fit in the big bank box buying investment properties, they can just decline us. And when people decline us for purchases, we're not used to that. We go into a store, we buy a shirt, we pay for the shirt, we walk out. But when we're trying to buy houses, you have to qualify for that. And people don't like hearing no when they're trying to buy stuff. So online, you could have people, I don't like dealing with Home Trust or Equitable. That's the two big B lenders. I don't like dealing with them. They declined me and tried to charge me high rates. Well, that's their business.
Yeah. Okay, two more questions on this. What kind of rental offsets do B lenders have?
About 80%. So they're pretty high. They use about 80% rental offset on your existing rentals. Now, depending on the B lender, some of them will care if it's vacant or not. Some will use market rent if it's vacant properties, but generally they're using about 80%.
Okay. And do B lenders like lending on short-term rentals, Airbnbs, stuff like that?
No, we love Airbnbs as investors because they're great cash flow, but banks don't like lending on known Airbnbs because they fall under they look more like hotel and motels to the bank. And that causes a problem on the residential side. So you have issues with the residential purchase of an Airbnb. They're just going to have problems with it. Most people will end up having to go like that. It all depends on the property. You know, if you're buying a rental property and, you know, your plan is, it's a cottage, I'm going to live in it. And, you know, maybe I'll rent it out down the road. Well, that's different because now you're buying, you know, a cottage, or you're buying a potential full, you know, long-term rental. But if you're coming in with a listing that has like 3 cottages on 1 plot of land, and it says, you know, great Airbnb rental, this is awesome cash flow, the banks are going to see that listing, and the banks are going to say, this is an Airbnb. We don't do Airbnbs. So it all depends on how. Now, same could be said. You could be buying an Airbnb that's marketed like an Airbnb, and you could say to me, but Dan, it's not going to be an Airbnb. I'm planning on renting it out long term. However, in real estate and with the banks, if it walks like a duck and it talks like a duck, it's a duck. So if it looks like an Airbnb, if it walks like an Airbnb, that's how they're going to treat it. And they don't have an appetite for Airbnbs because it falls more under the commercial side, despite it being a residential home.
So similar to student rentals, when we're after properties like that, typically we'll ask the listing agent to change a description, get rid of the short-term rental, rent by room, Airbnb, all that language out of the listing, and present it as a single family home.
That's one way. Absolutely. You know, another way is to look at the numbers with the private lender, because investing it's all about numbers. It's like, you know, how many properties in this situation, if you had to go private lender with, you know, a property with 3 houses on it that you can Airbnb, that you're going to cash flow, even with the private lender, you're going to cash flow $1,500 a month. Well, why wouldn't you look at the private lender at that point? It's just all about numbers. It's all about the investment.
Okay. Does the size of the existing mortgage matter when it comes to approval for, I guess, with B lenders for investment mortgage?
The size of the mortgage? Well, I mean, you're still qualifying. So the B lenders will still want some level of qualification. Excuse me, they're going to be looking at your business bank statements, right? So if you're a contractor that's working under the table and has no income to show, the B lenders are going to have a problem with that. They want to see some proof of income. But if you're, you know, a contractor, if you're maybe a contract masseuse or something, and you're getting money coming into your bank account, that's the income they're going to show. So the qualification with the B lender is based on the income you're showing going into your business bank account. It's non-tax. That's the difference. They're going to calculate your income pre-tax. The A lenders are calculating it all post-tax. They want your net income after deductions.
Got it. Okay, let's move on to a bit of a different topic, but like guys and gals, if you're curious about this B lending stuff and you think it might be right for you, I mean, the best idea is just to reach out directly to Dan, and I'll provide his contact info if you don't have it already. And these guys can help you out. So how does a typical investor, you know, like me or like Moj or like Dimitri on here, what's the typical scenario or flow? How do we get to like getting, you know, 5, 7, 8 mortgages now? Like, how has it changed, and how do we do this if pretending we're a new investor today?
Well, for the people that, again, are in Southern Ontario, we've been blessed with the last 10 years of like massive appreciation of the properties and the assets we've acquired. So we anticipate that to continue. I'm sure Paul has economic updates, but, you know, when you look at the immigration that's coming, when you look at the challenges we faced in 2020 and 2021, the real estate market has stayed strong. So we all believe the market will continue to grow. And that's key for an investor, because the trick for investing is to come back and re-access money from the assets that we acquire. And right now, that's 100% contributing to the mass hysteria, which is the real estate market right now. You've got people that bought properties 10 years ago. Let's say they bought them. Paul, you got clients like this, right? I think even yourself, they bought them $300,000-$400,000 properties. Well, those properties are worth like $800,000 now. And if they haven't done anything with their properties and in terms of re-accessing money, they're now sitting there with maybe a mortgage of like, you know, 200 grand, 250 grand, and access to like 300,000-400,000 through a line of, you know, through the equity in their house. So we get a lot of investors that come to us and say, Dan, how do I unlock all this equity? I'm sitting here with a house that's worth $800,000-$900,000. I only owe $200,000. What do I do? So we start by, you know, trying to restructure the existing mortgage that you have and add on some sort of access to capital. So whether that be a home equity line or whether we restructure the mortgage and pull it out, investors are coming back to that original investment to re-access the money to buy another property. Now this is what will blow your mind in terms of affordability. So let's imagine we then want to take, and I don't know if you can find a property for 500,000, but my math is easier at that number. So let's use that as the example. But if you want to go buy a house for $500,000, you're going to need to borrow $100,000 for down payment because you need 20% down. So if you have a home equity line of credit on your existing house or a rental, whatever it is, if you have access to a home equity line, the cost to borrow $100,000 today based on prime plus a half, which is the standard rate with HELOCs, you're paying $245 a month of interest-only payments. Okay. Now interest only because that's all you would pay. It's a tax deduction when you're using this money to go purchase an investment property. The down payment is tax deductible. So you're creating tax deductible debt on your owner occupied home, which is not easy to do, but this is a strategy these people are doing. Excuse me. So the cost now, if we're buying this $500,000 house and we're borrowing $100,000 for the down payment, that's going to cost us $245 a month. But we still have to borrow $400,000 on the house, right? We bought for $5,000. We got $100,000 for down payment. $400,000 has to be set up in a mortgage. Well, that $400,000 based on a variable rate today is going to cost you about $1,500 a month. So you're looking at carrying the down payment and the mortgage amount for about $1,750 a month. That's it. Now, property taxes, insurance, right? Add that on. You could be all in now on a $500,000 property for $2,000 a month, give or take. So as long as your property is now cash flowing above that, and I think it's reasonable at, 500,000 that you're cash flowing more than $2,000, you're bringing in more than $2,000 in rent, depending on how many units. But as long as that property is cash flowing, you've now leveraged your existing equity to go and buy more investments. And that's, for anybody who's heard the term, get your money working for you. That's what you got to do. I mean, get that money out there working for you, because what's it doing in your house? Nothing. It looks nice to look at a mortgage statement and say, I got a house worth 800,000, 900,000. I only owe 150. But what is that money doing? And most investors are reaccessing that money to take it and go and buy other properties. And with the cost of mortgages, they're pretty cheap right now. Rates are pretty low, but the rental cost is going up. I mean, not just is the cost of housing, but the rental market, the cost of renting is going up. The supply is short, and you can take everything away, from economics, strip it down. The one thing you can't take away is supply and demand. And the supply is short for both housing ownership and for renting right now, especially in the GTA. So long-winded answer, but they're coming back, reaccessing money from their house at cheap cost to go and invest it on other properties. And then again, you do the same. Now, after you've bought 2-3 properties, remember, for those that don't know, you can access up to 80% on qualifying, 80% of the value of your home. So if you have a $900,000 house, you can access $720,000 out of that house. So if you owe 150 grand, that's like, I can't do the math that quick, but that's like 600 and something grand of a HELOC you can have. So you can scale having through that one property. I could scale that investor to get them 4 or 5 properties, just depends on the price.
Okay, cool. And like, is there a certain typical order or something of lenders that you would go to, like TD first or RBC first or whatever?
Yeah, the lenders, they are limiting. Like some banks will allow you to have more properties than others. So RBC is a good example. They're a great lender. They only let you have 5 properties total for the most part. So if you're going to RBC, they're only going to let you have 5. So we try to use banks like that up first, and then leave like a bank like CIBC till the end. CIBC, they don't have any limits on properties you can have outside of them, but they'll limit you to 5 with them. So for an investor who's trying to scale, remember I talked about interest rate a little bit earlier, but here's a good example. Let's imagine I have an investor that wants to buy 5 or 10 properties, okay? And their focus is interest rate. That's the only thing that matters. I got to have the lowest rate, so I'm going to go wherever gives me the lowest rate. Well, let's imagine this investor goes to CIBC for their first 5 properties. They've just eaten up 5 properties at CIBC at best rate. They can't go back to RBC now because RBC will say you're maxed out. Whereas if that same investor went to RBC first and bought 5 properties, they could then go to CIBC after, because CIBC will say, yeah, we don't care. As many as you have outside, you can only get 5 with us. So the order is important for the investor. ideally you would want to go in a certain order, but that's the thing. Every bank is different on how they qualify you. Some will count the limit of a home equity line of credit against you. So I'm sitting here saying, oh, go access a home equity line for 500K. Well, that can actually impact you on your pre-approval. So you want to make sure if you're doing that, it's not going to impact your ability to qualify. So sometimes the deal will drive which lender I have to go to. That happens often. But yes, you always want to keep in mind which lenders you're going to, because some will limit your ability to scale. For sure. They all do. It's just a question of when.
Okay, cool. Let's see. We have a bunch of questions coming through. Here's always an evergreen favorite. Do you foresee interest rates going up in the next 2 to 5 years?
Yeah, you know how many times I've been wrong with interest rate predictions in the last year or two? Who knows? I mean, yeah, I would say so. Rates can't stay this low. I think people are seeing now. You're seeing a rebound on the bonds, so fixed rates have gone up the last couple of weeks. We're hearing they may go up again. But interestingly enough, we're seeing a decrease to the variable rate, not the prime rate, but a decrease to the discount on variable. So for anybody that has variable rate, generally you're in, say, for example, prime minus 60 or prime minus 70. As the fixed rates are increasing, we're seeing a little dip on prime minus 60 to prime minus 65. And that's good. That means the variable rate right now is actually decreasing, the discount. We're back to a more normal market. Previously, the last 18 months, during COVID and prior to that, we were in what was called an inverted yield curve. And for real estate investors, and for interest rates, that's an important time, because what that means is variable rate is actually higher than fixed rate. And that's not normal in the market, right? One of the things we love about variable generally is it's a lower rate. It's riskier because the rates can go up, but we love it because it's a lower rate. So for about 12 to 18 months, variable was sitting higher. I had people that when presented the option, do you want a fixed or variable? And the variable's higher. Why would anybody take a variable rate? People are taking fixed rates. It's a lower rate. It's more secure. Unless you were banking on prime rate dropping, it would have been the right move, essentially, taking that fixed rate. So we saw, obviously, when COVID hit, a drop of variable rate by 1.5%. And that's pushed variable rates. They were almost on par there now at that point. There was quite a difference between fixed and variable. But when COVID hit and prime rate dropped 3 times, 1.5% last year, that sort of evened the playing field of fixed and variable being back to even. And now we're starting to see a larger gap of variable versus fixed, where depending on whether it's an investment property or an insured mortgage, you're going to see anywhere from like 1.5% to 2%, give or take, on a variable. And on a fixed rate, you could see anywhere from 2 to 2.5%. So we're starting to now see a more balanced interest rate, believe it or not. Even though fixed are going up, that's what we want in the market. We want balance, and higher interest rates will help balance the market.
Got it. Okay, I think Naweed missed the first 20 minutes or so. Naweed, yes, you can get qualified if you're self-employed. When I send the recording, I'd suggest paying attention in the first 20 minutes there. And it's all about B-lending, what that is and how it helps self-employed people get approved for properties, personal and investment otherwise. So that's an important.
Thank you, Paul. Yeah, I did miss that one. I apologize. Yeah, thank you.
Okay,
I'll
so
just watch the recordings then.
detention for you, buddy. Is it possible to put less than 20% down on an investment property?
Answer is no. You can't put less than 20% down on a rental. But here's where the area can be interpreted in different ways. And I'll explain. We have a lot of investors that will come to us and say, you know what, Dan, I want to buy a house for my son or my daughter who's going away to school. Okay. I want to buy them a house for them to live in. So believe it or not, let me rewind. When you're buying a house in Canada, okay, you always have to disclose your intention. Okay. There's only 3 ways you can intend to buy a property in Canada. Okay. There's owner occupied. I'm going to buy it and I'm going to live in it. There's an investment property, which is like your flip or your rental. And then there's secondary home. And a secondary home is if you're buying a cottage or if you're buying a home for a family member to live in. My son or daughter is going to school. I'm going to buy them a property to live in. That's actually a secondary home. And the reason why the disclosure of the intent is so important is because the mortgage insurers in Canada, CMHC, Genworth, and Canada Guarantee, they're all the same. They do the same thing, but that's the 3. They will not insure a property that we say is a rental. So if you go to CMHC at 5% down and say, my plan is to rent this property out, they're going to decline you because they don't insure rental properties. But if you're buying a property that your daughter or your son is going to be living in, and you can afford to qualify on your own for this purchase, then that's not a rental property. That's a secondary home. And that can qualify at 5 or 10% down. So you can acquire an asset and the intention can change after, meaning we get lots of people that will buy an owner occupied home. Then they'll decide, you know what, I want to upgrade. I want to move into a bigger house, but I'm going to keep my existing house as a rental. Well, there's nothing wrong with that. You can change your mind after closing, right? You can buy a house for your son or daughter, and when they're done school, you can change it to a rental, but it's how it's presented to the lender. If the insurer says this is a rental property, you have no choice but to do 20% down.
Okay, so now that everybody who has more than 5 properties is going to lose their mind here, but if you already have a bunch of rentals and then you want to buy a cottage for your son or daughter, or a student rental for your son or daughter, or a duplex for your son or daughter, you can't. I'll just help you and answer. You can't buy a triplex or a fourplex after you have that many properties with less than 20% down. So
it's hard. Again, walks like a duck, talks like a duck. You're right on. It's like, of course, people will try to be creative and say, well, why don't I just say this? Well, number one, it's very hard to qualify. Remember, you're qualifying to carry with your existing debt and mortgage a brand new purchase with no rental income. And that's tough to qualify. Generally nowadays, just so people have an idea, if you have zero debt on your application, no car payments, nothing, at 5% down, you're going to qualify for about 5 times your income in terms of purchase price. So $100,000 income with zero debt is about a $500,000 purchase price. So for those thinking I may be able to do secondary home, just remember you have to have a really strong application to qualify. But as Paul mentioned, it's not, this isn't something to be abused in the eyes of the insurer. If they look at you and say, you've got 5 rental properties and you want to try to buy this duplex at 5% down. No, you're an investor trying to buy rentals. That's 20% down.
Got it. Okay. What else we got here? Okay. So, for these people who you're seeing, Dan, who might have 3, 4, 5, 6, 7, 8 properties already, purely from a financing perspective, I have a different perspective from a strategy point of view. But from a financing perspective, when do you think it makes sense to transition or consider moving from residential to commercial?
Comfort level. The thing about commercial that people like is it actually has nothing to do with your personal application. Commercial is all about the property. Like multifamily investing, multi-units, it's all about the property. So your actual application doesn't really matter at that point. It's a little bit more expensive because you may have to fork out like $1,500 for an appraisal up front, because the approvals on commercial is a lot based on the finances of the property, the rent roll, and the appraisal. So it's a little bit more expensive up front, but it's qualified more on the property. And so to say, when should somebody do that? It's really a comfort level thing. I mean, I would always say start with residential. I mean, it's easier to manage 1 or 2 people than it is to manage an 11 unit with, 2, 3 people living in each unit. But certainly, I mean, they can be pretty lucrative. There's a lot of people that like the commercial world, a little bit trickier to get financing on. But again, there's B lender options, there's private lender options, there's actually insured options. You can actually get an insured CMHC multifamily at 15% down, believe it or not. Now, it's very tough to qualify for, but there is a product for that out there.
Yeah, that's a whole other Q&A or masterclass topic.
Yes. Yeah.
The reality is, to answer that question directly, I mean, you even though multifamily is fantastic and a lot of people come to me for multifamily, we're typically going to start with, single family duplexes and triplexes and even fourplexes before we go up to commercial, because there's a funny saying that goes, you don't buy multifamily, and I mean commercial multifamily. So you don't buy multifamily to make money, you buy multifamily when you have money. So it's more of a place to park your money, because the process to turn around the property, refinance and do all that work, a BRRRR or a value add, as we like to say, is very, very profitable, but takes much longer. So when you're building your portfolio to begin with, it's more advantageous for you to build a base of smaller properties that you can leverage. Then you can refinance those and use the money to buy the bigger multifamily. Okay.
Yeah.
That's the ideal, absolutely ideal scenario. And if you've ever met with me on a one-on-one, and I know a bunch of you have, you've seen me draw the diagram of the little ecosystem that we like to build for portfolios. And if you've never met with me and you've never seen my cheesy diagram, you should see it. Just shoot me an email and we can chat. But before this question gets out of hand, because I've seen it 30 times now, no, you can't get traditional mortgages to go and flip properties 10 times in a year. It's not going to work. So you need to use private financing. So Dan may have contacts for you, so you can reach out to him and do that. I even have some contacts who do that kind of stuff. So reach out to me and I can connect you with these guys. And, you know, it's private money. It's a little bit expensive, but it's very short term. And the idea is that you're in and then you get out within a few months, you take your profit, they take their profit, and everybody's happy. Okay. So don't kill me if you don't like the rate.
You're doing my job for me. I love it. But you're right. You're right. Flips it's all about numbers. So you can't focus too much on rate. Number one, you're not in it for very long. So fees, that's just a part of private lending. Condition of the home is very important. If it's just for cosmetics, it's all about qualifying. The applicant would have to qualify if it's just cosmetics for that purchase.
Okay. Well, let's open it up to some questions. If you want to unmute yourself, please feel free. Otherwise, I'm just going to read some of these that are coming through. Is it possible to close on two properties around the same time without financing being pulled on the first property? So I guess without losing financing on the first one.
Yeah, for sure. Banks will do when you're doing two deals at once, banks will do double adjudication and they just use a different qualification method. But yeah, you can absolutely close two deals at once. Sometimes it's easy to send one deal to one bank and one deal to another bank just to avoid the double adjudication. And you just sort of, you can tell bank A, well, they have a purchase closing on this day for bank B. And you tell bank B, yeah, well, they have a purchase on this deal closing on this day. And you can avoid that double adjudication, which in the mortgage world, it just means it makes the deal a little bit harder to qualify. But yeah, absolutely. You can do two deals at once.
Okay. And can you find financing for property investment in the US? In my experience, you need to use your line of credit here to finance in the US. And there are some lenders in the US who will finance you with it's like 50, 60, 65 loan to value. And, it's essentially a private mortgage. So you really got to do your numbers and know what you're doing there.
Yeah, I would agree. We usually, anybody working in the US, I don't any lender get existing real estate in Canada to try to finance the purchase of a property in the US.
Okay. Can you do mortgages under a corporation? Oh boy, go for it.
Oh yeah. Yeah. We do mortgages under a corporation. Absolutely. We get that question a lot. I know there's a lot of talk. It's like the hot question. Can I go in firm is one, and should I be buying under a corp is the other. I get that all the time. So to us, it doesn't matter whether you buy under a corp. Here's the most common things I get. So, and what I always ask my investors is, why do you want to buy under a corp? Like, what is the reason? And here's the most common answers I get. One, it will remove liability. Well, that's not true because you're personally guaranteeing any property under a corp. So liability is not removed by buying under the corporation because you're personally guaranteeing it. So you just have to make sure you have a good insurance policy and you should be covered there. Number two, I hear that it can lower your tax. Now, from what I've researched and from my contacts, that usually might make sense at about 4 or 5 properties, but anything previous to 4 or 5 properties, there's not a lot of tax benefits to incorporate. People will think, well, I can qualify under the corporation. Well, that's not true either. You have to personally guaranteeing it. You're qualifying under your personal application. People will say, well, I want to do it because I have a joint venture. Well, you can do a joint venture agreement rather than do it together under a corporation, because sometimes that can be limiting, having 2 people on a corporation buying a property. And when those people want to separate and go buy individual properties, owning a property together can cause a deficit in your cash flow with some lenders in terms of qualifying. So that can be a negative. Then people will say, well, it'll help me get more properties. Well, that's not necessarily true because every bank will do corporate purchases. So you can go to all banks and scale. It's no problem. People say, well, I want to move it in trust. I want to eventually move it to a family member in trust, and I want to avoid the land transfer. Well, again, you can buy it in trust to a corporation and close under the personal name. But all you're really going to do by buying under a corporation, aside from maybe the tax benefits, is you're going to pay more. Number one, a mortgage brokerage or somebody like myself, we charge a fee to process the deal under a corporation. It's a little bit more involved. A normal charge for a brokerage is 1% on something like that, 1% of the mortgage amount. We limit that for any of the Rockstar or Pulse clients to a $2,000 fee, but there's a fee for us. So you have to pay that one time. Accounting, you're going to pay higher accounting every year. So there's a lot of accountants out there that like to say, yes, buy under a corp. I will charge you corporate taxes every year, $2,000, $2,500, and then we'll just keep buying it like that. So buying under a corp, it can make sense if for tax reasons, but I need to understand why the person is buying under a corp. It's more expensive legal. So you're adding more cost to your applications, potentially unnecessarily. So it doesn't matter. You're qualifying personally. So to us, it makes no difference. It's just more expensive to the client.
If you're watching me eat a carrot, I'm just working on my beach body for the summer. So don't.
No, you want me to filibuster for a bit while you chew that carrot?
My answer to everyone is simply an accounting question. I mean, it doesn't change. If you're trying to qualify for a residential mortgage, it's typically going to be more difficult and cause a few more issues. But if there's a tax benefit on the back end, then yeah, absolutely use it. And you could, but sometimes it's better to close in your personal name, but with the corporation as the beneficiary, or in trust, as some people would say. So I'm just picking on a name here. Rajesh is closing in his personal name, but the sole beneficiary is the corporation. Another way to say that is in trust or a bear trust, something like that. When you get to commercial, it's all corporation.
Yeah, absolutely.
I won't even sign the agreement if you're not using a corporation.
Yeah.
That's insanity. Even the bank's going to tell you you're nuts.
Yes, absolutely. Commercial is all done under the corp.
Yes. Let me see here. Can you take equity on a pre-construction at closing? Okay, so I think you're saying if there's equity more than the 80% equity, can you take it all out at closing?
Okay, so good question. Here's how this works. So if you have a house, let's say we bought a pre-con 4 years ago at like 400K, and now it's worth 600K. Okay, so can we access that 600K? So a couple different questions. You can access it if you're selling it on assignment. That new buyer can actually buy it at the new price, and the bank will finance prior to closing. They will finance that new price. RBC, as long as it appraises, they'll finance the price. But you as the owner, if you don't sell it, you can't change the price, or you can't change the purchase price and the value of the home until after closing. So once the deal closes, yes, you can come back and apply for like a home equity line of credit based on the increase of the value. Banks will tell you generally we have a rule 6 months, but they'll waive that rule. I mean, if the property's gone up over the last 4 years so much, you can absolutely go back and re-access the money, but you have to close on it at the current value. That's all.
Got it. Thank you.
I'll try to buy you more time.
Go ahead.
Hey, Paul, it's Tanjeet. Dan, this is great. Question for you guys is, do you have programs where you can get, say, 80% on a first with the A or B, and then perhaps the remaining 20% on a private in the interim while you're doing renovations, et cetera, and then be able to burr it out at the end after a year or so?
Yeah, it's tough. I know there's other brokers that do stuff like that on BRRRRs where they finance 100%. It's risky. The problem is I wouldn't put any of my investors at 100% financing. So the problem with that is in that system, whoever's setting that up is you're lending people's money out at risk at 100% financing. And if there's any change in the market or something, those investors are going to be out a lot of money. So I understand the need for it. I'm not saying it's a bad idea, but we don't offer a product like that because we find the risk just too much. I could find a private lender on the outside to maybe try to combine a B lender approval with 100% financing, but it's going to be expensive. It's not going to be sort of built in together.
I totally agree with Dan. If you're new to flipping or newer to investing, and you're coming to me wanting to go do 100% financing, like uh, I'm not necessarily responsible for what you do after closing, but I do feel responsible for your results, and that's why there's 100 people on this call, is because people I work with get good results, and I want you to get good results. So that's dangerous, and I know Tanjeet very well, and he's super experienced. So if he wants to do that, go do it. But if you're newer, I'm going to have something to say too before you even talk to Dan. However, I do have some lenders who work with flippers who will go up to very close to 100%, probably somewhere in the 90 to 95 for short-term money. I'm talking like less than a year. Okay. And it's expensive. It's like 15% interest only kind of stuff.
But that's more like builder loans, right, Paul? Not necessarily borrowing the down payment at 100% to just buy a house.
No, they need a little bit of down payment, like a deposit check. Sometimes a deposit on the property is enough. I mean, maybe a little bit more. That's their business model. And but they're used to working with flippers, but now they've kind of expanded and they want to work with. They're open to working with experienced people who are doing these type of BRRRR or value add plays where there's an interim period. They need like a construction loan, for example, and they just wrap it up into one product. So again, they won't work with anybody either. I mean, they qualify you like it's a job application. Like you have to show them that you're a good investor. So there's products out there and different people out there, but I do agree with Dan. Like you got to know what you're doing if you're going to get into something like that for sure. So we got time for one more question.
Yeah, can I just jump in? Dan, I have my wife is working with a client, and they are only qualified for 600,000 in this market. Both couples work. So I'm wondering if we try to move them to a B lender, how much do you think they can get max from a B lender? The banks are giving them 600 only at this time.
It really depends. It really depends on the first question I would ask is how much down payment are they working with? Because if it's less than 20, the B lender won't look at them. But if it's 20% down, I'd have to really look at the app and see what the limitations are. Again, if they're self-employed, then maybe the bank is limiting them because of the provable income.
No, they have regular jobs. Two of them have regular jobs. So
yeah, I'd have to look at the whole file to give you a direct answer. But the down payment would be key. Are we assuming they have at least 20% down?
At least they have 10%.
They have to have at least 20 to offer them a B lender option.
Okay, nice to know. Thanks.
No problem.
Okay, thanks everyone. And just a final closing message. Like financing is so important, and it's a vital part of your strategy and how you're going to move forward. Now, none of us are going to be able to acquire more properties unless you want to buy them in cash, which is not the greatest idea. So, I mean, there's always going to be an obstacle, and I run into obstacles all the time. And you just got to bang your head, against the wall enough. I don't actually bang your head against the wall, but you know what I'm trying to say. You got to just keep searching and find all the solutions. And to be fair, and I'm not trying to throw Dan under the bus, sometimes Dan might not have the solutions, and he might refer you to somebody else. And the same way with me, like if you're looking for an industrial factory, I'm not your guy. I can't help you. You know what I mean? So, but come to us, talk to us about what you're trying to accomplish. And if there's a better source or Dan has a better source, we'll help you because this is more of a relationship business than it is a transactional one. At least that's what it is for us. So we're here to help as much as we can, but got to communicate and talk to us and let us know what's on your mind. And it helps with strategy sessions. So before we go, I'm going to put Dan's email through the chat here. What's the email now? Dan at BM Select.
Look at that. I just hit enter and I had it in there for you.
Oh, yeah, you're Daniel at BM Select. So I'm going to send it through an email with the recording anyway. So don't worry about it if you miss it. But if you need to reach him, Daniel at BM Select. Everybody should have my email, but just in case there's someone here who doesn't, I'm putting my email through. If you want a one-on-one session with me and you want to talk about how we have success with all these investors on here, I mean, we'll chat. 30 minutes. I'm gonna shake you to a straight line. Trust me. I do it for a lot of people.
No nonsense, Paul. That's what we call them.
No, Authenticity is very, I find authenticity is very much lacking in our culture right now. So I want to be as authentic as possible. I know that sounds cocky, but I don't care. So anyway, thanks for joining us. I hope you guys have a good lunch, and we'll talk soon, guys. I'll send you the recording. Thanks, everyone.
Thanks, everyone. Thanks, Paul.
See ya.
Thanks, Dan. Thanks, Paul.
Bye-bye. See you, buddy.
Take care, man. I'm sorry. Oh, there it is. All right. See you, buddy.